what does a slower pace of rate cuts mean for investors next year? Joining us now, we've got Cayla Seder. She's a macro multi-asset strategist at State Street. We've also got Michael Hands, the Chief Investment Officer at Citizens Wealth. Thanks for joining us, guys. I want to start with you, Cayla. Where do we go from here? Obviously, we have started to see a recovery in the market today. What's that recovery going to look like heading into year end?
Yeah, thanks so much for having me, Madison and Seana. I would say, this is a really good reminder that when we look at equity markets, we really need to look at, high quality growth parts of the market. And so moving into 2025, what that tells me is, we're still going to see tech outperform, and we're not really going to see a broadening out, which is something that has been a question as the Fed entered its cutting cycle. Is I think there was a lot of the market that was looking for, outperformance of small caps or outperformance of even some parts of value. And really what this tells us and what we learned from the Fed yesterday is, we're probably not going to see that broadening out, and we really need to stick with high quality growth.
Do you agree with that, Michael, that we'll likely see this concentration within the markets play out?
I think in the near term, the reaction is oriented around that positioning. To us, the balance of the year, I think, is going to play out dependent upon the incoming data. So what we're thinking is just a few months ago, the mindset of the Fed was we have to cut aggressively. And all of a sudden yesterday, they've moved from a coin flip to a 25 basis point cut and outlining to the marketplace that they're going to slow. So I think it's really going to be about the data. And our positioning is that in the near term, market volatility is going to be oriented around just the reaction to yesterday, but it's going to be the data and the incoming administration and their policy that's going to dictate 2025 and beyond.
Michael, sticking with you for a second, Torsten Slok this morning saying that there's about a 40% chance that in 2025 we could see the Fed hiking rates. If we do get that, what does that do to the market rally?
I think the mindset from Torsten, we've spent a lot of time with him, and I review his commentary all the time. It's on the back of a stronger macro environment. So if the economic environment dictates the need to cut in conjunction, or in the need to raise in conjunction with elevated inflation, I think the markets can react to that in a positive fashion, because that will also be indicative of a strong growth environment for corporate profitability.
Cayla, when it comes to where finding those opportunities, you mentioned the fact that we could see that outperformance in tech. I guess my question then is, to what degree does that outperformance look like? Because here we are, we're not too far from some of those record highs. We have seen some buying opportunity. We have seen investors once again favor these names. How much more room is there to run in some of these market favorites?
That is the key question. I can tell you from what we see in our data, which a lot of it focuses more on those institutional investors. When we got to the starting point of 2024, the conversation was, okay, we're already overweight tech. Where do we go to next? And really what we've seen is that because the options elsewhere are not that attractive, you can also look at this from a regional perspective. If you're thinking of maybe it's time to move out of the US equity space to elsewhere, the answer is the US is still the best option. We still see high quality growth as the best option. And so because of that, because of the macro environment and the fundamental strength behind those parts of the market, you're probably still going to see positions increase, even though there's already overweight positioning. So really what that looks like, I think, from an overall equity perspective is that, yes, equity markets will still be okay, especially if what Michael was alluding to with stronger growth, maybe that means a higher neutral rate, and therefore that's the reason why rates can't fall as low as markets had expected before. That still creates a okay environment for equities. You're just not going to see that broadening out.
Cayla, are you at all worried just about the drama that's happening down in D.C.? We could potentially see a government shutdown, that's going to halt some of this momentum right here?
I think it could, but I think where you're going to see that play out more is in the rate space. And so really this ties back to looking at the potential for a bear steepener in 2025. And so we've seen, quite a bit of adjustment over the past 24 hours. I'd say on the long end, there's still room to run.
Okay, but given the policy positions moving forward here and the lack of clarity about them, Michael, I want to end on how you are pricing in the Fed's divergence when it comes to thinking about policy. We had heard Powell saying that they are not considering policy from the incoming administration, and then yesterday he said actually some Fed members are. How do you digest that decision from the Fed?
We've felt all along that the stance and the rhetoric is going to be to ignore the incoming administration, and it's going to be the data. So the two are ultimately the same. It's going to take some time. There's going to be uncertainty. We look at this as a strong opportunity. We've felt for the last several months that we're going to be in a higher for longer environment and regime. That's a net positive for investors because, to the earlier points, you don't have to go that far out on the curve because there's potential risk for higher rates. At the front end with limited duration exposure, you can capture really attractive income and yields, which I think will balance your overall portfolio.
All right, Michael and Cayla, thanks so much for taking the time to join us here this morning.